On this week's episode 5, I have Georgia from Sprint Ventures. Welcome, Georgia, to the show.
Thank you, Ray, for having me. It's a real pleasure.
It's been ages since we spoke. Tell me how you went from our days at Westpac together to now being in Sprint Ventures
Thanks, Ray. Yeah, so we worked together at Westpac how many years ago? 10.
over 10 years ago.
But, we're so young still, so it's okay.
For sure.
So I have there's sort of two pathways into venture capital. One is as a startup entrepreneur, and you have that kind of founder entrepreneur background, and you go into the kind of other side of the ecosystem, into the investing side. And then the other way, the other path into venture capital is through the corporate side. And that's really the way I've come in. So I'm a chartered accountant. I've spent a long time in the banking industry in a number of different functions. So I did actually spend quite a lot of time in the technology space and implementing change projects in tech. And I've always been really passionate about trying to improve processes. I'm very process driven. So if we can make things better, and the best way to do that is with tech, I'm always really excited about that. After spending a long time in banking, I actually worked for a family office in
Oh,
London.
nice.
There's a bit of a crossover into venture capital land with a lot of family offices invest a small portion of their portfolio in VC. So
Listen,
when I came back to Australia, I was exploring that opportunity and then met Sprint, who had only really been around for about 18 months at that stage. And I just loved the idea of working across a broader mandate, very tech focused. And our mission is to build a better future. So we invest in impact, which for me is really values aligned with what I want to do with my life. So I jumped on it. It was super exciting, not really knowing a huge amount about venture capital, but being a bit of a chameleon, I can sort of slot in anywhere. I've just loved it ever since.
yeah, for the listeners who aren't familiar with the term family office, how would you describe what a family office is and how does it work?
Yeah, so a family office is commercializing the investment process for a family that has a significant amount of wealth. And there is a spectrum to that. So it could be as low as something like a $10 million investment portfolio up to hundreds and hundreds and hundreds billions maybe of an investment portfolio.
Mm.
And often it comes out of a family business. So it can originate, especially in Australia where this concept is still fairly nascent, it can originate out of the family business. You might find the finance director of the family business is helping with some investment decisions that the family wants to make to diversify their portfolio. And then it graduates to a process where actually there is a team that's separate from the family business, or maybe the family business has exited or is being run in a different way. And the family office is a separate unit that works with the family on looking at all of the assets and investments in their portfolio, and really structuring a longer term view on building growth.
Yeah. So the three that I'm aware of, like when I'm working with startups, when they're looking for funding, they talk about family offices or angel investors, individuals, private equity, and venture capitalists. And how would you differentiate them on how they work and what they do differently?
Yeah, so family offices, they can either invest directly in startups if they have a particular interest and maybe a background in that space and understand it a little better, or they can invest in startups through a fund manager.
Okay.
So that would be like a Sprint Ventures, and their decision would be around, we want to diversify our portfolio, we want some investments in alternative assets. We like VC and PE. We like the idea of maybe growing businesses, but not having to do it ourselves anymore. We're maybe past that. Maybe a bit of giving back, maybe a bit of wanting to be part of the next generation of businesses in the tech space.
Hmm.
So they go through a fund manager like Sprint Ventures who has the experience and the network of opportunities for them to invest in. And so you can, as a startup, approach your family office directly, but there's no white pages for family
Yeah,
offices.
I was going to
Links
ask.
and advertise.
How?
You can't find them. It's all through warm introductions. And that is really the only way, because not only can you not find them, they also are approached by a lot of people. So they're really hard to find, and they're very private. And that is a special quality of family offices and something I'm familiar with. So family offices can be really early stage investors. They can fall into that angel category, like the first maybe external capital that you get into your startup. But they can also be further down the line if they're really big, or if they're investing through a fund manager. Then you have the venture capital funds, and they start investing in around the kind of pre-seed stage. So product maybe is being built, there's an idea, no revenue, no customers, all the way down until about Series B, Series C. So we're talking about valuations around, look, it varies, but it might be a valuation of around 50 mil. And that's when PE starts dipping in as well. So private equity has a completely different investment mandate to venture capital. Do you want me to get into that? Or
I think that's pretty good for describing the three. So you mentioned family office are difficult to find, venture capital probably easier to find. What advice do you have for startups on building their network, since the last few founders that I've interviewed mentioned the importance of bringing people on their journey, on being able to build that network early, because it's probably late when you need money to start introductions and meeting people. What advice do you have?
So I would start with having a look at who the venture capital investors are in Australia. And Airtree, one of the big VC funds, actually has an open source list
Oh, nice.
of VC funds. Yeah, if you just go to their website, they've got a link, open source, and they've got a investor list, I think it's called. And it's really handy because it has just a little bit of brief information on what stages the VCs invest in, and if they have any particular areas of investment that they like to focus on. They can be agnostic, which means they look at everything, or they can be specific in maybe they like particular areas. So you can really hone in on the investors that you would like to speak to that are well aligned with your business. That is one thing I would do. And I would start doing some outreach. Now, when you do outreach, it is from my perspective, when I receive outreach, I get literally hundreds of emails every week. So it's really hard to get cut through. And whenever I get an email, I just refer everyone straight to our website where you can apply for funding. Whether you are looking for funding or not, it's a great way to get into a venture capital fund's sort of database.
Yeah.
And then what they will do is they'll have a look, they'll see if there's a mandate fit, if there's a stage and a timing fit, and then they'll reach out, and then you can develop a relationship that way. It's really hard, unless you have a really warm introduction, to go directly to a VC, just because of the volume of contact we have. It's nothing to do with you. It's nothing to do with the VCs. It's just really hard to get through all of those. So go through the website, go through a really warm introduction if you can. And then the other thing that I see gets a cut through for me is VCs go and speak on a lot of panels and a lot of startup events. It's important for us to meet really great founders. And if you have the opportunity to go to those, and if you have the opportunity to introduce yourself afterwards, that is always the best way to connect to someone face to face. So go and do that. Go and talk to them and have your 10-second pitch ready to say, I'm a pre-seed startup in the health tech space, and I know Sprint's a health tech investor, and I'd love to send you my information. And then boom, it's in my brand. So you got to hit it at another number of different angles. So like you said, Ray, you've got to, if you think you're going down that path, if you want to raise capital externally, you need to do it
early
sooner rather than later. Yeah.
Yeah. What are some of the most memorable interactions that you've had, and what stands out about them with startups? Not going to replicate it, but
to start with a bad one.
Okay. Yeah, go ahead. Yes. Tell us what bad looks like.
Okay. This is terrible, but there's a founder I keep running into, which is great. He's out there and he's doing what I said, right? But I still don't know what his startup does.
Okay.
So he will bail me up. He will talk. And I'm just like overwhelmed. I can't even process what he's saying. And he's doing this every time. And I still have no idea what he's done. So that's not great. That's not
No.
great. Really good is, I know this is old school, but I really like business cards. And the
Oh,
reason
wow.
why, and I'm terrible at taking mine places, so I should take a leaf out of my own book. But do you know what the great thing about a business card is, as opposed to just like a LinkedIn connection, is that I find the business card in my bag at the end of the day,
Yeah, in your pocket. Yeah.
whatever it is. And it's like that reinforcement. And so
Yeah.
I look at the card and I go, oh yeah, I met that lady, this awards event I went to 2 weeks ago, and she's got an OT tech startup. And then I look it up I'm like, oh, this is interesting. And then she's in my brain. It's trying to get cut through.
Yeah. I'm preparing a pitch deck right now, not asking for funding. Uh, what do you see in pitch decks what are the fundamentals that you would say are important in a pitch deck when
Yeah.
submitting it?
Yes. So it does vary slightly depending on what stage you're raising. If you're very early and doing a pre-seed raise, you don't have a huge amount to go on. But if you're in Series A and you're generating revenue and entering another market, you've got to provide a hell of a lot more substantial detail. So we just think about it generally and
Yeah,
and
like let's
kind of
start with
early
pre-seed.
stage.
Yeah, early stage, pre-revenue.
Pre-seed. Yeah. So the one thing that I see repeatedly missed is the competitor analysis.
Oh my gosh, I'm just working on that slide right now. This, yeah,
You,
it's painful to
you,
do also.
it's painful, and you actually have to be really brutal. And a lot of people think, okay, I do this this is my startup, and no one else does it. And okay, maybe no one else does exactly what you do, but I guarantee you,
Mhm. God.
but I guarantee you there are 15 to 20 global startups
Mhm.
or even incumbents doing something similar.
Mhm.
And it's not just, and you have to look at the incumbents as well. You have to look at what the status quo is, because if you are trying to sell to customers and say, look, my product is amazing, it does X, Y, Z, and it's faster, it's cheaper, it's quicker, it's going to make you more money and all this sort of stuff, that you still have to get them to decide to stop using something that they're already doing and put
Mhm.
something new in place.
Yeah.
It's the whole process itself. In your competitor analysis, you have to be really brutal on the space, and you need to include all sorts of different types of competitors that you might not consider, but who actually do threaten your market size. And the more detailed you go on that and the more information you provide, it actually helps with your process as well,
Mhm.
making sure what you're building, there really is a big market for it. And that if you, depending on what stage you're at, that you are pricing it properly, that you are going up to the right sort of customer profile and so on. So it's a really good process for yourself. But it's really important when you're asking for capital that you represent the true competitive market. That's the biggest one I see missed and super important. There's heaps of guidance on what to put in a pitch deck. So I don't, you can just Google it and see what you put in. But at the really early stage, we are investing in the founding team.
Yeah.
So you've got to really explain why
Yeah.
are you the best person to solve this problem. And the other thing is it's around the market size at this stage. So you might have an idea for a solution, and it might be something that evolves over time and pivots. And over a 2-year period, you might actually end up with something that looks completely different.
For sure.
So it's not really about your solution, because we know that changes. It's around sort of the market opportunity. And for a venture capital fund to invest in a startup, the market opportunity has to be absolutely gigantic.
Okay.
Now, that is not a technical term. It's not a technical term. You need to have a global growth ambition. And the market opportunity needs to be gigantic because we need to invest in startups that are going to have a huge growth potential. So at the pre-seed stage, competitor analysis, market opportunity, and founding team. Why
Mhm.
now? What's your opportunity? Why you? And why is this unique?
So some of the comments from the founders now mention how lucky they were that they started their company 4 years ago during COVID when there was a
Mm.
lot of investment in digital products and they didn't have much built and they didn't have much of a team and they made a little prototype and they raised a couple millions. That they are honestly, they were honest that they would not be able to do that today. And their advice was that it's important to be able to prove your concept and to generate some revenue. If we're talking about now startups that are quite early, but generating revenue, probably not enough to take salaries. What's after that? What are you looking for now that these startups approaching you who have started making money? So they prove that they have a market and they have customers.
Mhm.
What are you looking for next?
That's actually a really great stage at the moment. The cost of capital has gone up significantly. It is really hard to raise capital. And when previously a pre-seed venture capital fund was happy to put a couple of mil into a really early stage idea,
Mhm.
they anecdotally, what I'm seeing in the market right now is that people are really searching for revenue, which means
Mhm.
that they're more like a seed investor. I would say
Yeah.
VCs are not playing as much of the pre-seed stage anymore. So if you actually have revenue, you're in a much better place to be raising capital right now. So
Okay.
that's a good thing. That's a really good thing. And so really what we focus on at Sprint, if you've got some revenue, it does not in any way just where you've got product market fit. It just means that often the first couple of customers for a startup will be very close connections. It might be the business that the entrepreneur came out of or whatever it
Mhm.
might be. So that's sometimes a bit of an easier sell, so to speak, than getting a brand new customer. But what we want to see, what we really delve into in due diligence is what your pipeline looks like.
Yeah. Mhm.
And that is really important. And just as an example, we were looking at a defense company just recently, and well, the defense industry in Australia is a fraction of the size of the US
Mhm.
and Europe, for instance. And so for that startup to be a really investable opportunity, they need to display a strong pipeline in those markets
Yeah.
to really get that growth that we're looking for. And you can't have a strong pipeline if you don't have connections, if you
For
don't
sure.
have a pathway to those sort of customers. And that may look different in different industries. In the health industry, it might be that you're doing clinical trials with a US
Mhm.
university or whatever it might be. And so if you're starting to generate revenue, the focus is really on the strength of your pipeline. So you need to have a good CRM system. You have a really good process around your sales cycle, starting to bed down and some real detail on that so you can go through it.
Feels so good. I'm raising capital right now to fund the opportunities I need to pay for infrastructure. I need to build out some processes. The funds are specifically targeted to close deals. You mentioned due diligence. I only see these are the things you don't see on Shark Tank because you see the pitch and then you don't really get to see which deals close. So you talked us through the approach to VC firms, getting the cut through. What happens after you are interested? What happens before from that point on until funds are raised? Or
Yeah. Okay. So I'll just take one tiny step back from that question and say that we get about 100 applications for funding each month. Some VCs they might see even more than that. So the process that we have puts those 100 opportunities through a pipeline, and there's very few that make it through to investments. So if you get a no, it might be for a number of just different reasons that are not personal. And we know this is a sales process, raising capital, and you're going to have to pound on way many doors than you are going to get capital. So just bear that in mind and just be prepared for that, that it is a process. When as application for funding comes through to us, we have a look at a couple of very high level things. Does it fit our mandate? Does the capital raise, so that is like the areas that we invest in, does it have that impact focus that we look for specifically? Is it in the stages that we invest in? So if it's a Series B, that's too late for us. We like pre-seed and Series A. And then if the timing is right. So have we only have Series A capital available at the moment. We've fully deployed our earlier stages.
Mhm.
So you might be an awesome mandate fit pre-seed company, but we don't have any capital in that stage right now. So it could be a timing thing as well. We also tend to invest mostly in Australia. There is a little bit we can do outside of Australia, but if you're offshore startup, it's going to be unlikely. So there's just like that first scan to see that there is a fit, mandate and timing and stage. So if that passes, it goes into the next stage and we have a look at, as a team and as investment team, we have a look, we'd say, oh, we've seen this one, what do we think, what do we know? And the team will say, oh, look, I saw one like really similar to that the other day, or I know that market's really saturated. I've done due diligence on something similar. So then it might just be a couple more no's. And then we come to a smaller amount that we then will put through to our investment committee as an initial, do we want to start our process on this? And it would be a yes or a no. And if that moves through the investment committee, the initial decision, we then go through an investment review, which is like a light due diligence, where we take the information that the founders given us and we actually validate that with our own research. So if you are claiming your market size is 3 trillion globally, we are then going to go off and do our own validation of what that looks like. We're going to research who you are as founders. We're going to dig through your profiles, Google you. One startup I looked at last year, one of the founders had a criminal conviction. So this is the sort of stuff we are not looking for necessarily, but that we uncover at this stage.
Yeah.
And then if we get through investment review and there's no major red flags, we will vote then to put it through due diligence. So then we start looking really deep. We start looking at your customer contracts, speaking to customers about their experience. We look at employment contracts. We look at your shareholders agreement. We look at all sorts of things around making sure that the company is set up properly, that it's got everything that it's been set up with the right kind of governance in place, and there's no barriers. And that everything that has been reported, so we're looking at financials and things like that, that everything has been reported is accurate as well. So it's all really about transparency and really getting to know each other very deeply, because if you do take outside investment, you are entering into a very long relationship with someone. So we really get to know each other, what's and all at that stage. And then so once the due diligence paper is completed, we do a final vote from the investment committee to say, yes, we're happy to invest. And we really lock in then how much, depending on the instrument of the capital raise and any other factors that we might consider around the deal itself. And that whole process is taking a lot longer now because everyone's being more diligent on their due diligence. We've always been conservative in our due diligence, and it depends on the time frame of that process. Can depend on a number of things. It depends on how many other deals we're doing due diligence on at the moment. Team is only so big, so we can only do so many once. It depends on how quickly you have your data room ready and how quickly you respond to questions and how quickly we can get through the process.
Yeah.
And then other things that might come up that throw a spanner in the works. So it can be, look, we just signed a term sheet for a new investment, a new startup that we're investing in. And we've actually been talking to them for about 2 years. And we missed a prior round. We've been building our relationship. We've been coaching them towards their new raise. We've been working on this term sheet with them. And so that's actually 2 years. That's a really long process. So usually it doesn't take that long. But a couple of months, I would expect 2 to 3 months for a reasonably normal paced kind of due diligence process from first meeting to getting a decision.
Once you're in due diligence, you mentioned the pipeline and how many contacts you get. What's the likelihood of those falling through? Is it quite rare that it makes it that far and it doesn't happen, or quite common?
Yeah, I would say it's more on the rare side. We certainly
Mhm.
don't want to all that time in if we
Exactly.
think it's not going to go anywhere. It's more likely that it's going to happen, but that is really where a lot of the kind of legal and the governance stuff gets uncovered, and
Mhm.
that can be a real deal breaker on a number of deals. If you, as I've seen some startups that have ongoing kind of litigation issues, whether it might be with IP or previous founders or with an entity that they merged in or started from or whatever it might be, and those things can really kill a deal.
Mhm.
It's always great to front run those conversations because you also, as a founder, won't be wasting time. It comes out right at the end, and then the potential investor goes, "Why didn't you tell me about this?
Mhm.
This is a huge deal. We're putting the brakes on until we find out what problem is." So you don't want any surprises to come out at the end because that can kill a deal, or it can make it just flounder for months while things try to get resolved. But if you're going into due diligence, you're most likely, hopefully, there will be more success than not because no one wants to actually do the due diligence if they don't
And then
feel
lose the
strong.
deal. Yeah, exactly. You mentioned about governance a few times. What
Mhm.
does a great startup and their governance structure look like? What's the golden child of startups and their governance?
Yeah, yeah. Okay, so this is really important. I'm a bit of a governance geek, but at the
I sense that.
pre at the pre-seed stage, well, when you're building a company, you really need to think about this right from the start. And there are levels of governance that you require as you grow the business, but it always has to be consideration right at the start. We don't need like the gold standards at pre-seed stage, but it needs to be starting and it needs to be a consideration the business as you grow it. Because you certainly will not be able to exit if you do not have your ducks in a row. If you think about the due diligence from an investor giving you capital as you grow your business and the due diligence of a potential acquirer
Yeah.
when you want to exit, that is exponentially deeper if you do not have all your ducks in a row and you have got that governance going through as you build a company. You're going to have a real tough time at the end. For a pre-seed company, you want to have agreements between the founders. There might only be the founding team.
Mhm.
Might have, maybe you've got some outsourced resources, whether that's developers, offshore developers, or maybe someone, so some in some sort of function. But if it's just the founding team, you two need to have, or three or four, whatever it is, need to have agreements with each other, legal documentation as to who owns how much of the shares, what your roles are,
Mhm.
things like whether you've agreed on vesting, so whether there's things that you can put in place. Founders will gain their total shareholding over a number of years so that it aligns with their motivation of staying and growing the company. Good leaver, bad leaver, those sorts of things you really need to have in place right at the start. You need to have a shareholders agreement and a constitution. You need to have a board. You need to
Mhm.
have directors of a company. That may only be the founding team, and that's okay at that stage. But you need to actually have directors appointed to the company, and you should be documenting and formalizing the process around board level decisions at this
Mhm.
stage. And it might just be very light and it might be not on a frequent basis, but you still need to have that in place so that you can show to potential investors that you have a level of sophistication with
Mhm.
your business. It's really important to have that.
I'm working through my shareholder agreement right now and a term sheet for my third starting member, and including all the like sale restrictions and the vesting schedule. So
Yeah.
I'm glad I'm doing the right homework right now.
Good job, bro.
One of the reasons I started a company recently is that after 4 years of working with incubators to advise, I feel like some of my knowledge is out of date. And if I'm not practicing what I preach and I'm not doing it, then whatever advice I'm giving to startup founders is out of date and not applicable. It's similar to when I was consulting. Like there's a certain point when I wanted to become an employee just to know what it's like again to go through the activities rather than follow the news. And there's a big difference in reading about something and doing it yourself and getting into the details.
Yeah. The other thing is the market, the financial markets, and this is what we're talking about. If you're getting capital from an investor, the financial markets go through cycles. And so one year in COVID, when there was plenty of capital, it was free, interest rates were zero. Everyone was at home and bored and wanting to do something, and anyone could raise capital on a huge amount, big valuations, versus now where valuations are incredibly squeezed and you're not getting as much capital, and you have to have a really lean mindset in how you grow your business. And then you have to talk to 300 investors instead of 100 investors, and cap raising takes 12 months instead of 6 months, and so on. Those market cycles are really important to understand as well, because if you raised in 21, you are going to get a rude shock right now if you go out to raise, because it's not going to be the same experience.
Yeah. I often talk to founders around the shareholders, the investors that they've brought on board, and give me your perspective of composition of investors. Does it matter who invested before externally, who the lead investors are? How much does it play a role when you're looking at startups on the existing investors? And do you have a view of having to be a lead investor in a startup or not?
Yeah, so I think when you think about the people you want to raise capital from, you need to consider what else they can bring to the table other than just financial capital. So we like investing in particular industries because we can bring so much more value to our startups. We can bring experience, connections, all sorts of things. So have a look at when you are talking to people, ask the question during the Q&A, how can we work together? What sort of value can you provide on an ongoing basis?
Yeah.
If you invest in us, because you really want the startup teams there's always skill gaps in startup teams. And if your investor can help fill that gap to an extent, that is amazing value that you can get more than just the money. So really be strategic as to who you get capital from. And then in terms of what I look at when I'm looking at investing in a company, there may be quite a couple of people on the cap table already. There might be their founders or their family trusts. There might be a couple of angels, those sorts of things. Or if it's a little bit further along, there might be some other VCs. And I'm looking at who else on the cap table is adding value and who else in the current round can add value as well. I'm looking for startups that have considered that too, and are being really clever around where they get their capital from. What was the other part of your question? Yeah,
Does it matter to be a lead investor or leading rounds?
We've done both. We've done both, and if we have really strong conviction and we're keen to lead, it also depends on timing. Sometimes we meet startups partway through their raise and they've already got a lead, and that's fine as well. So it really just depends. You're probably more likely to get a lead out of investor that you have built a relationship with rather than just cold off the bat. And then there's different profiles as well. As you move through the capital raises, you are looking for people who can give you capital, maybe that can introduce you to customers, that can help fill skills gaps. And then you can also consider what we call strategic investors, which are maybe big corporates or incumbents in your market that can help with partnership channel strategy, particularly into new markets or new geographies, and even later down the track, consider buying you as part of their suite of products. So that's another consideration as well, is who could potentially buy us, and can we start developing that relationship now? Now, there's pros and cons with that as well, because strategic acquirers know what they're doing and they can so on the term sheet, they might not be the lead, but they can have a side letter to the term sheet, which requires certain conditions in the event that the startup does want to go to market to sell the business. They might have first right of refusal and things like that. So you need to be careful around those conditions not being too restrictive, but that can be a really interesting consideration as it goes through growing your business as well.
I have a follow-up question to that one. Do you see sale restrictions in startup companies where the existing investors or shareholders are not able to sell their shares either to other specific people, or like what conditions have you seen in terms of sale restrictions?
Yeah, there can be some really restrictive conditions. One of our portfolio companies raised in the last 12 months with an incredible group of investors internationally, one being a strategic investor. And there was about a 2-month process on their side letter and the terms around a potential acquisition in future.
Mhm.
And it did start off quite restrictive. So they wanted, remember the term they used, but they wanted like a 60-day exclusivity period where they could do their due diligence and decide whether they wanted to buy the company. But that's quite a long time. And that blocks other opportunities. And when you're selling your business, you want as many interested parties as possible. So if you are shoehorned into a situation where you really only have one looking at you at one time who has already lots of deep connections and quite a lot of maybe power in the situation, you don't want that to impact your ability to sell to other people
For sure.
or
Yeah.
even pursue that opportunity. So it can be quite restrictive and you have to be very careful. Make sure you've got good lawyers, and there will be compromise and negotiation on this, but it can be really positive.
Yeah. Are there
And
share restrictions that you see going from pre-seed, seed to Series A that are green flags that are good to have in place? Are Because I've seen this in some shareholder agreements to have restrictions, and I don't really understand the reason. It could be that you don't want to have a disgruntled shareholder sell to a competitor. But other than that, do you see any uh, important features of having a sale restriction through the earlier stages?
there are always generally restrictions in the shareholders agreement around who can sell and for how
Who can
much.
buy?
Full restrictions around whether founders can sell as
Mm,
well. So just bear that in mind too. It's really standard. What I would say maybe the really great things that you potentially could look for, although they're not common, is when you get external capital from sophisticated investors like VCs, LP companies, they get preference shares, and the founders and the employees and maybe some of the earlier angels and early investors, ordinary shares, they have different rights.
okay.
And if, for instance, a VC is offering to invest with ordinary shares as opposed to preference shares, that would be a real green flag. But I haven't seen that. Okay. So it just depends on how much sort of power you have in the process and what you can ask for.
Okay. I have one more question. It's one that comes across my table often. It's around raising capital and dilution. Many founders want to bootstrap their company a little bit longer to hold on to their entire company versus raising capital and having to lose a portion of the company. In return, similar to what you mentioned, you gain strategic advice. You are able to fill a skill gap. What's your advice on founders thinking about this balance between giving up part of their company, but gaining the support that they don't have?
Very simply, I think the big benefit of raising external capital is that you get an injection of cash that can allow you to supercharge your growth. So instead of bootstrapping and growing in line with your revenue growth, you can front run that, hire a bunch of people, salespeople, developers, whatever it is, build the product faster, sell it faster, and just accelerate your growth. So that's the big benefit of raising external capital. But if you do go down that path, I like to talk about getting on the capital raising train. If you get on the train, you never get off.
Okay.
Okay. So yeah, so you'll always have external investors. You will always have external shareholders that you need to account for and work with. And as a VC, we want you to grow, and we want you to grow exponentially until you get to a huge amount of value and then you exit. And so you won't just be raising capital once.
Okay.
we want you to raise capital many times so that you can grow. So if you get on the cap raising train, you've got to be prepared for the journey. And I think it's a different business model. If you want to bootstrap your company and which is what that is absolutely the right choice for many people. And bearing in mind that very few companies are actually VC backable, it's the only choice for many companies. And you can still grow an incredible business by bootstrapping it and growing it to a size that is manageable for you and still having a meaningful exit if you want to do that. There's nothing wrong with that at all. But if you have global growth ambitions, if you want to build the next Canva or you want to build the next Atlassian or whatever it is, if those are your ambitions, you're going to have to raise external capital because you need to grow really fast. You need to go global. You need to get ahead of the competition as well. So you need that speed of growth. And if that is truly your ambition and that is truly the market opportunity, you will find VCs who want to invest in you. But if that's not what you want to do, then VC capital might not be aligned with your ambitions. And that's okay too. There's many ways to grow a business.
Perfect. That was my last question. Do you have any closing words or advice to startup founders who are listening to you?
I have a lot of respect to startup founders, and it is a really tough journey and a really brave journey as well. And I think that having a really strong support team around you is important, whether that's a co-founder, whether that's your family, whether that is some early believers and investors. Just make sure you've got a support unit around you because there's going to be ups and downs and it's going to be tricky, but it's a really brave, courageous, and inspiring choice. So I wish everyone luck.
Thank you very much, Georgia, for your time today.
Thanks, Ray.